And what's up, you guys? Welcome to the Mango Grove. My name is Krisha, and this is today's Bitcoin and macro market update analysis video. I know it's usually Sean covering the macro market stuff, but because he's not going to be doing a video today, and because, well, price is moving across the board, we're seeing these crazy pullbacks, breaking structure on some of the charts. We're seeing pullbacks across the board, and yeah, there is a reason behind it. So we will be talking about that reason behind why markets as a whole are dumping right now. Now, I'm not going to jump the gun. Let's first start off with the agenda, okay, for the day. Today, I'm going to start off with a bit of housekeeping, and then we'll be moving on over to why the markets are dumping. Okay, in addition to the key economic data releases happening in the next 1 week. And this, guys, I'm saying watch out, because this is going to be very important. The data that comes out in the next 1 week is going to be very, very important. It's essentially what's going to dictate what happens to price action from here. Okay, it's going to dictate what is said in the next FOMC meeting. Alrighty, and then after those key points are spoken about, we'll then move on over to Bitcoin's price outlook. Because whatever data that comes out of these two things right here, okay, that is going to affect the price of Bitcoin. All right, so we will be prioritizing in this order. Now, as far as housekeeping is concerned, guys, well, it is my birthday in around 2 days. So usually the tradition is that every time it's either my birthday or Sean's birthday or Jesus' birthday, which is Christmas, we do run sales, okay? So right now there is a sale running for my birthday. The coupon code is Krisha-birthday. I'll be, well, linking it on the screen right here. That is going to be the coupon code. It is applicable on the seed program as well as the Mango dynamic indicator. Okay, now, of course, for those of you who always ask me, Krisha, which one should I get? I always and will always recommend the Mango Seed program. That will give you the base foundation you need to read any freaking chart out there. Not just read any chart, to even trade any chart, okay? Because you're even getting a beautiful risk management system with the Mango Seed program. Your risk management system, guys, is everything. If there's any time to be jumping and hunkering down and learning this stuff, it is now. This is where the knowledge that you gain can translate to the greatest impact in your portfolio. It is during these phases of the market. Okay, imagine anyone who basically jumped in right here at 3K, they were then able to apply their knowledge throughout the entire run. Alrighty, so it pays dividends when you actually do invest in your knowledge at these critical junctures of the market. So yeah, the seed program is on sale. So if I had to recommend anything, yeah, grab the seed. So that is one of the well, the housekeeping things. The second thing on the housekeeping, guys, is Sean has actually added a brand new module to the Mango Seed program. Now, the first part of the module, he focuses on trading psychology, and the concepts that he goes over here is, well, you guys are going to feel it very, very viscerally, because many of us have fallen victim to the psychological fallacies. Now, Sean has really broken it down to identify the underlying problem and make sure that you are able to identify it too, just so that you don't fall victim to those fallacies. Okay, so yeah, go ahead and give it a watch if you are in the Mango Seed program. You should have gotten a notification, but yeah, I'm just letting you guys know. So these are the two housekeeping things for today. With this, guys, we can move on over to the first point on the agenda, which is why in the world are the markets dumping to begin with? So now yesterday, Jay Powell actually had something to say. I'm not sure if it was a conference or an impromptu meeting. Now, if you guys have more information on that, let me know in the comment section below. But anyways, he did speak yesterday. Now, if you guys have been following the Mango channel for some time, you guys know how much, well, we've been focusing on the macro market, specifically every time we do have that FOMC meeting. Because what's happened so far is that the markets have gotten very, very, very sensitive to any monetary policy that's coming out. Okay, not just monetary policy. A part of monetary policy you guys need to understand is this entire idea of forward guidance, right? I'm just going to say FG. FG equals forward guidance, okay? Or some people would like to call it Fed speak. They've been using this tool to basically guide markets in a certain direction before they even switch monetary policy. And it's been working really, really, really well, okay? Over the past, year now. All right, so now yesterday he came out with something else to say, and that has sort of led to an adverse move in the market. For those of you who are not aware of what was said, now even I did not watch the actual meeting. However, I did find a little source that's going to help us out with the key sort of elements of his of what was said by Jerome Powell yesterday. Okay, I'm going to take you to this side right here, which is CNBC. Now they've quoted him. Now one of the key statements that Jerome Powell actually made was this, and I quote: "The latest economic data have come in stronger than expected. which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. So just with this statement alone, guys, he's being hawkish here. Okay, he's basically telling people that, all right, these interest rates now are going to come in higher than previously anticipated, because the markets, when it comes to interest rates, guys, the markets are forward pricing. Alrighty, so now the market so far has been pricing in a pretty decent, a pretty slow, gradual upward trend in interest rates. Nothing very, very drastic. And that's why we actually saw Bitcoin rally. We saw S&P rally, right? The markets were looking pretty good so far. Right, so now he comes out with this statement. Now, in addition to this statement that was made, he goes on to say, he says, if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of interest hikes. Now, the most important word in that statement was this one right here, pace of rate hikes. Okay, that pace was very important, because in one of his meetings, I think this was the one back in December, someone had actually asked him a question after he spoke, asking him primarily about the pace of rate hikes, because he had been hiking interest rates, guys, by 75 basis points on a month-to-month basis. Okay, now for those of you who are wondering, Krisha, why is this even freaking important to begin with? Guys, interest rates, I keep saying this, is the price of money ultimately. When the price of money gets cheap, people are going to be more inclined to borrow. When the price of money gets cheap, you're more likely to spend. Okay, and that's why the price of money means everything in terms of whether or not the markets are bullish or the markets are bearish. People either go risk on or risk off. When the price of money gets cheap, people go risk on. That means Bitcoin pumps, equities pump, housing pumps. Okay, so interest rates are very, very important. Now, this pace, he had been increasing interest rates by 75, 75, 75. Now, when asked about the pace back in December, he said, no, we're going to be waiting on economic data. And he alluded to them slowing down the pace. So now he's come out basically going back on that little statement that he made, or rather that little answer that he gave that woman who asked the question. Okay, so this was very important when he says that he will be prepared to increase the pace of rate hikes. That is a very hawkish statement. However, please note what led to that. He said if the totality of the data were to indicate that faster tightening is warranted, only then will he increase the pace of it. So now what data is he looking at here? Well, he's looking at two key elements, okay? One, let's go back on over to our chart. Okay, one is inflation. Apologies for my crusty handwriting. And the second one is employment, okay, with the primary focus on inflation. Okay, this is the primary focus because, as many of you guys know, inflation was running hot and they were trying to bring those numbers down, right? So now, because of everything that was said in his meeting, okay, check out what happened to, well, the forecast. Now, we have been looking at the Fed watch tool together for some time, right? Which is this right here. This is where the market essentially forecasts the next interest rate hike, right? So right now, as things stand, only 26.5% of people are forecasting a 25 basis point hike, okay? And 73.5% of people are forecasting a 50 basis point hike. Now, what's wrong with this? What's wrong with this? And I also want to give a major shout out to Dominic from the Mango Grove, who actually posted a chart on this, which then prompted me to go and look into the Fed Watch tool to look at these forecasts because something very drastic changed here. All right, for those of you who do not know what changed, check this out. I'm going to take you guys on over to my notebook. Okay, I'm going to scribble here for you guys. So now this right here is 26.5%. This is a 25 basis point rate hike. This right here is 73.5%. This is at the 50 basis point rate hike. This is what people are forecasting. 73% of people are forecasting 50, only 26 are forecasting 25. However, just 2 days ago, okay, I want you guys to focus on this table right now. Okay, this one right here. All right, I'm gonna get rid of this column. Okay, which was 1 day ago. We're not looking at data from 1 day ago. I want you to look at, well, last week. Sorry, not 2 days ago, last week. Okay, last week to now. Okay, and last week, guys, I mean, that was a matter of freaking less than 7 days. Last week was what? We're not even done the week. It's only a Wednesday, right? So just last week, check out the data. When it came to the 25 basis point rate hike and the forecast for 25 basis point rate hikes, 76% of people were anticipating 25, 76, which has now dropped to 26.5%. Okay. And as far as the 50 basis point rate hike is concerned, just last week, only 24% of people thought he was going to increase it by 50 basis points. Okay, so those numbers, guys, those numbers have actually just switched. Okay, and they switched very drastically, very suddenly, and this is what you're seeing translate onto the chart right now. However, are the markets overreacting? Perhaps. Now, I say perhaps, guys, it's because the information that's going to drive the next interest rate hike is what? The two pieces of information we need is, well, the CPI data, okay, and the second one, that's the first one, and the second one are the employment numbers. Now, the main question is, have any of these pieces of data actually come out? The answer to that question is frigging no, okay? We don't have the answer to any of those two, well, data points just yet. Now, we do get CPI data coming out on 14th of March. All right, and employment numbers come out on my birthday, actually, 10th of March. For some freaking reason, I always notice that there's always some stupid drastic event that happens around my birthday. Like, I'm never really truly able to enjoy it because I'm always looking at my tap trader and just, you know, be like, okay, what's markets doing? What's markets doing? So ever since 2017, I kid you not, my birthday has always been a very, very eventful time. Mine and Sean's, believe it or not. But anywho, these are the two very, very important dates that we are going to have to look out for. March 10th and March 14th. Okay, March 14th is going to be CPI, March 10th, employment numbers. All right, so now at what point will all of these, will the 75 basis point and 25 basis point really switch? You know, at what point can we actually switch back? Where's my red? Okay, what point will we sort of switch back from, well, this being 76 and this going back to 24-ish, okay, approximately. Well, let's see. If there's one thing that Jerome Powell was very clear about in his last FOMC meeting, he said that, hey, listen, if CPI comes in high, okay, now CPI, guys, is your direct reflection of inflation. CPI translates to Consumer Price Index. They basically take a basket of goods in everyone's households, okay, basically your generic goods in everyone's households, and they calculate the price of that, and they look at the difference in terms of how much those prices have risen from a month-to-month basis. Okay, that gives them a sort of gauge on inflation. Okay, now if CPI comes in high this month, in addition to employment coming in high, this combination is going to lead to a hike in interest rates. Okay, this is something that Jerome Powell was very, very clear about. Now, the scenario that's going to flip the tables once again, essentially this coming to fruition, okay, 76% of people thinking that we're only going to get a 25 basis point hike and 24 thinking we're only going to get a 50 basis point hike. If that, for that situation to come to fruition, okay, what we're going to be looking for is for CPI, number one, CPI I believe is going to be the most sort of important gauge here. For CPI to come in low, okay, either equal to or less than what was forecasted. And for employment to come in low. Okay, that is going to be sort of the ultimate bullish indicator, at which point I do believe that markets will likely rally. We're going to see these numbers switch once again, with majority forecasting a 25 basis point rate hike and the minority at the 50 basis point rate hike. Okay, so this is going to be that bullish sort of scenario for the markets, okay, especially when it comes to the forecasts. And I think that the thing about when you look at these forecasts, markets are forward pricing. So that is going to be priced in on the charts as soon as these numbers actually come out. Now, what's cool is that all of these numbers precede the FOMC meeting. Okay, so we get these releases first, and only then do we get the FOMC meeting, which happens in 2 weeks from now. Alrighty, so if we get this combination, markets are likely going to rally. Hell, even if employment comes in up and not down, even if employment comes in higher, I still think that this is going to be a good picture. Why? Because at this point, this will likely be alluding to a soft landing. That soft landing that the Fed had actually wanted to begin with. That was their initial goal, right? To be able to accomplish a soft landing without the economy heading into a full-fledged, very ugly recession. Okay, now, like I said, we don't have these data points just yet. So yes, there is a possibility that the markets might very well be overreacting. The two key pieces of information we need in order to make a very, very informed forecast is going to be the CPI data and the employment number. And with the more weight given to CPI is inflation. If there's anything they have been stressing on time and time again, JPA has been coming out, the most important gauge that's going to basically lead to, well, the next interest rate decision is going to be CPI. Now, because markets are forward pricing, guys, this is the scenario that's being priced in, even though we don't have the data to support it just yet. People are anticipating based on what he said. They're like, okay, rates are going to go up. The pace of interest rates are going to increase. So people price that in, okay? When they anticipate that, they price that in first, okay? Forward guidance always helps. It's been working for now over a year. However, if data comes out in line of this sort of trajectory right here, we can expect markets to rally once again. It could be a relief rally, it could be trend continuation. We'll have to wait and watch to see what happens. Now, just a quick heads up, when I speak of employment data, any of the data, we're looking at data in relation to the previous month's data. Okay, now we have the previous month's data, right? So now depending on what comes out in the present day, okay, so it is this in relation to what came out last month. Is it up or is it down? Alrighty, that's how you look at the data. So when I say employment going up or employment going down, it is in relation to the previous data point that we have. Okay, so yeah, the key dates here is 14 March is CPI, 10th March is employment. Alrighty, so eyes on the prize. And with this now we can get into the chart. Now this is Bitcoin's chart. We could be overreacting here. However, I'm a big proponent of TA guiding the way. So let's go ahead and see what the TA is telling us. As many of you guys know, as far as the monthly, now this is something that I'd really recommend, just freaking eyes on the macro, man. The macro will sort of keep you in those, in your trades. It will help you to assess the charts with a bit of objectivity, okay? And make sure that you're not getting too spooked out of any of your long-term allocations. Alrighty, if there's anything that's worse than getting spooked out of just any sort of range trade or even trend trade, it's getting spooked out of your long-term allocations. Like, those can really, really hurt. Okay, so make sure you're not getting spooked out of your long-term allocations. For that, look at the monthly, look at the weekly. Okay, those are the two time frames I will ask you guys to look at. So now we are looking at two key levels on the monthly time frame. Once again, we're going to keep this very, very simple. We're looking at the monthly 55 EMA and we're looking at the monthly 10 simple moving average. Now, I have a lot of my bull run triggers hinged on one level, right? And that can be seen on, well, let's go ahead on the weekly time frame, put on the dynamic. I'm going to box this region out for you. Okay, that way we have key zones of support that we want to see Bitcoin hold, because if Bitcoin does not hold these levels, that means something very different is happening on the chart. Okay, at which point we'll have to sort of prepare for contingencies, look ahead, see what the data is telling us. Are we in for like a surprise shock? Is the Fed trying to break the market? Right? Are they're trying to propel people into a much deeper recession? We don't know that yet, but the charts will paint the picture. Let TA be those, let your technical analysis as well as your indicators be that objective force in your entire analysis. The objective force, whether it be your TA, your indicators, it sets in a perimeter. That way you're able to know when price is sort of living outside this perimeter, and it sort of helps you check your biases. Okay, so let it be the objective force. Now I have my indicators right here. I have my bull run triggers. I have these EMAs that I'm looking at, the EMA, 55 EMA and the 10 SMA. This is going to help me stay objective. Okay, so now I have this zone here, which is the weekly dynamic. I'm going to mark it out for you right here. Let's look at the second bull run trigger, which is this. Okay, you can see that the 4-day dynamic, the lower threshold of the 4-day dynamic also lies in there. Okay, how about the monthly oscillators? Only we'll get some closure on that on the month close, which we are very, very far away from right now. And now the third indicator that I have was the weekly Ichimoku, the fourth, sorry, was Ichimoku dynamic, right? Which is, let's go ahead and turn it on. I think we're currently living underneath that, but that never really triggered to begin with. And yeah, we're currently living underneath that region. Okay, but still that's all sort of within the same sort of zones that I have marked out on my chart. Now we have this in addition to the daily golden cross. Let's go ahead and you know, pull it up very quickly. And okay, now you can see that this box technically highlights that daily golden cross support that we have, right? We have the 55 EMA and the 200 exponential moving average. Now I'll say this. As soon as Bitcoin loses on the daily time frame, guys, as you can see, we lost the 55 EMA and we actually got a retest of the 55 EMA on today's daily open, right? So now you can see the red box sort of highlights it. If I take you guys on over to some of my lower time frames, you'll see that we broke here, came back up for a retest, and then we saw a swift move to the downside. I do believe that Bitcoin does see continuation on this move right here, and we could likely see an official test of the 200 exponential moving average. Okay, let me just sort of fix my scale right there. Okay, 200 exponential moving average, which comes in at around 21.7K. Alrighty, from where price is at right now, 221.7K is a good, I mean, it's less than 1%, okay? But what we're seeing also over here is a breakdown of a bear flag. For those of you who do not see it, this right here is the pole. Okay, and let me just get my brush out. This right here is the flag. If you look at a textbook definition of a rising channel, those are usually bearish patterns. But what makes it bearish, guys, is, well, the breakdown of the pattern. Because before then, what are you seeing here? It's just a series of higher highs, higher lows for the most part. This actually gave us a sort of a hint in that this is more bearish than your usual rising channel. And why is that? Because we put in a high here only to put in a lower high. Okay, so when you see these things, this is a quick tip for you guys, by the way. When you see patterns like this, and the highs are not able to get up to the previous high, especially in, well, rising channels or falling channels right here. Now, your typical rising channel will look something like this, right? Very, very difficult to tell. You'll have to wait on the break before you can get the tell in that, okay, this looks like it wants to move down further. But always wait on that break. But one that can give you a sign on growing technical weakness on the rising channel that will basically give you the tell in that, okay, this looks like it wants to break down quicker than most, is this. If price does this, we go up, put in another higher high, okay? However, on the third attempt, we fail to get up to that next high, fail to get up to the diagonal, and instead price basically gets up somewhere here and comes down. Okay, the failure to get up to the previous high or even higher, meeting the diagonal, okay, is basically giving you a hint in that, okay, we have growing technical weakness. We're likely going to break on the next attempt of support. And that's essentially what we did right here. Alrighty, so now we saw that breakdown, price continuation to the downside. Now let's go ahead and check out the measured move of the bear flag. The bear flag, guys, the measured move of the bear flag will take us all the way down to this yellow box territory, which also marks out our bull run triggers. All our bull run triggers is hinged on this support region. Okay, this comes in at around $20,960. So now these are the two key sort of zones that I'm going to be gunning for. Now, as soon as price actually breaks the 200 EMA, which is highlighted by the bottom of this red box territory at 21.7K, I will be anticipating price to come down further. First up, 21.2K going all the way down to 20.8K. When am I going to reevaluate my long-term stance on Bitcoin in terms of the entire market cycle? Because remember, right now I am still swinging bullish for as long as all of my bull run triggers stay intact, right? I'm going to be swinging. I'll have to sit and reevaluate my entire thesis on the market cycle if, guys, we close the month of March, okay, the month of March, underneath the monthly 10 simple moving average. Okay, this comes in at around 20.5K. We close the month of March, that monthly candle, underneath 20.5K. Something very different is happening on the chart at that point. Alrighty, so that's what I'll be looking for. But for now, guys, these are the most immediate targets to the downside. I do believe that Bitcoin is coming down slightly more, at the very least, to graze that daily 200 exponential moving average right there. Okay, marking out the golden cross for us. And also there's another thing, you know, we've never really gotten a golden cross emerging out of a accumulation phase of a bear market, only for it to cross bearish once again. This is going to be the first time that we actually see that if price dumps further. But now remember, I'm telling you that, you know, we could be seeing a bit of market inefficiency, especially considering that the key economic data that this dump is hinged on is not out yet. Okay, so we're about to get closure on that economic data very, very soon. That is going to tell us whether this reaction is warranted, okay? Because if the economic data is good, this is going to be an overreaction by the market. That's something that you ought to be prepared for. Okay, so just, yeah, take note of these key levels. Right now, yeah, I mean, I gotta play by the rules, okay? I've set rules for myself. I've basically separated myself in terms of an executor and a manager, and my manager self is telling me that, hey, listen, I have bull run triggers set for you that I have I've put in the freaking hard work to back test all of these things for you. You better follow the freaking rules. Okay, so now I have these rules and I'm going to follow it. All of my rules right now, guys, is basically hinged on this entire zone right here. Okay, 21.2K going all the way down to the monthly 10 simple moving average at around 20.5K. Alrighty, it's only when we lose these levels will I be like, uh-oh, something different is happening, at which point I will reevaluate my stance. Okay, so yeah, these are the key things to sort of look out for those of you interested in short-term price action. You guys know that I am anticipating an official test of 200 EMA. Is there anything else that I'm seeing on this chart? No, not really. I feel like if we actually come down to this level right here, guys, my level, we also break structure there, right? Because we'll be losing the weekly 21 EMA. We'll also be taking out the wick low of this entire structure, because right now, notice what's happening, right? We're putting in, let me just go ahead and bring that up. Putting in a series of higher highs and higher lows so far, okay, so far. The lowest point on this candle here comes in at around $21,376. Okay, so coming all the way down to my yellow box territory means that we break that entire structure too. So there's a lot that sort of happens there. We also lose the 21 EMA if we penetrate the yellow box territory. So yeah, watch out for that, but for now, like I said, I'm gonna call a spade, and until I lose my bull run triggers, I will still be tilting bullisher as far as the entire macro market cycle is concerned. And yeah, this is all I have for you for today, guys. I hope you guys enjoyed this video. And of course, if there's anything that you're seeing on the chart, if there's anything else you guys want some closure on, or if you guys want information on something else, let me know in the comments section and I will deliver. And also, guys, if you enjoyed today's video, if you enjoyed today's content, make sure to, well, smash that like button. If you think that this could help anyone else out there, make sure to share the video. Okay, and if you haven't already subscribed to the channel, go ahead and hit the subscribe, and I will see you in the next update. With this, trade safely, trade stress-free, trade the mango way, trade the easy way. Ciao, you guys.